Good morning. Welcome to Stock Market Today. It's Wednesday, January 22nd, 2020, and I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter. I'm at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for an email where I get a lot of the content for this show, as well as give you daily stock ideas to consider in your inbox every day before the market opened. So U.S. equities closed lower on Tuesday after fears of a recent outbreak of the coronavirus in China began to spread through the marketplace. Energy, industrials, and materials were the worst performers. REITs and utilities outperformed after leading the market last week. Consumer staples and healthcare also outperformed. So a very defensive feel at the sector level yesterday. Treasuries were stronger across the curve. The dollar was weaker against the yen, stronger versus the euro. Gold was down 20 basis points, and WTI crude was off by 30 basis points. And as we get to the desk this morning, futures are rebounding, up about 40 basis points on the heels of higher markets in Asia overnight. This possible spread or news of the virus in China really hit the Asian markets hard the previous day, seeing a bit of a rebound overnight last night. European markets are mixed in morning trading. Treasuries are mostly weaker. The curve is flattening. Dollar is stronger against the yen, weaker against the euro. Gold is little changed. WTI crude is down 70 basis points as it continues to march lower. Let's look at the structure here of the S&P 500, just a mild pullback on the virus fears in China. Now, we are starting to hear some reports of it spreading, but thus far, investors appear to be looking past that this morning. Mild pullback yesterday, futures rallying here this morning. Obviously, we don't want to be headline-driven investors. We want to be process-driven investors. So we want to identify the near-term support levels, right, which we've been doing for you. We bumped them up last week. Near-term support, 3,200 to 3,250. Still looking for resistance levels to form, right? Markets are still up near record highs. No price-based resistance is a natural function of that. RSI is bullish and remains overbought. Chaikin money flow is bullish as well. So as always, we advocate have a process, and part of your process should not be trading each and every headline that crosses the tape. We've identified key support here for you. As long as the market is above or holds key support, you want to identify leading stocks and leading areas of the market. Get those stocks when they're near term oversold with bullish money flow. Let's dive right in now. What are we writing about in the note today to Chaikin Analytics clients? Well, we touched on the modest sell-off on the outbreak of a virus in China. But equities do remain near record levels. Sentiment indicators are more greedy than fearful. And if I was going to try to find a data point that worried me in the marketplace, it would be sentiment becoming and remaining overly bullish. Small cap growth as emerging leadership. We're asking the question, and we'll take a look at the chart a little bit later on in the show. And as I said, futures do point to a higher open here today. Let's take a look at the power bars now. Dow lost 48 basis points yesterday, but the power bar actually strengthened. 8 bullish or very bullish stocks for 5 bearish or very bearish stocks. S&P 500 down 20 basis points, 142 to 55 bulls to bears. NASDAQ, call it flat, down 2 basis points, 31 to 6 bulls to bears there. Small caps were an underperformer yesterday, 658 to 225 there. A little bit of a risk off tone in the marketplace, disproportionately impacting the small caps. Bonds rallied up 1%, sending yields lower. That sent those bond proxies higher, right? Remember, we said REITs and utilities were the best performers yesterday. REITs up 1%, 6 bulls to 7 bears there, according to the Chaikin Power Bar. Small cap stocks and large cap stocks are bullish across the board. However, the major markets are mixed. Turning to our stock of the day now. Remember, the stock of the day is auto-generated based on the power gauge rating, and today's stock is Momo Inc. Closed at 35.83, down 3.92% yesterday, so hit pretty hard. Has a very bullish rating due to very strong earnings performance, attractive financial metrics, and positive expert activity. So when we take the 20 factors, 5 in each of these 4 categories, we come out with that very bullish rating. We have a stock that's in a strong trend, above a rising long-term trend line. But realistically, we've been choppy for a year. All right, strong industry group, interactive media and services. For me, it's an interesting name. I want to watch it because of the very bullish rating. The back and forth on relative strength, right? We can't get much traction to the upside from a relative performance standpoint, right? We tried to lead towards the tail end of last year, started this year by lagging, tried to lead once again. It's back and forth. No real discernible trend there on a relative basis. So the very bullish rating is not in agreement with the market model not in agreement, as the stock doesn't get traction on the relative performance side of the equation. Add to that we are overbought, rounding out of an overbought condition with mixed to slightly bearish money flow in the here and now. Do I want to take a look at Momo? Not really. Do I want to add it to a watch list and continue to monitor for the situation to improve? Absolutely. Right. I never feel like there's a wasted opportunity when you get a chance to look at a stock. You can add it to a watch list, either bullish or bearish. And when the criteria begin to come into line, well, then it becomes a more compelling opportunity. I've actually made a note to come back to Momo, which I'm going to do in the future, and see if the opportunity presents itself based on our process. I think that if you're just more of a breakout trader, you're just kind of watching this 41, 42 level, and on a breakout through that level, that might get you excited. But for me, in the process that I work with, I want to see a very bullish stock leading the market become oversold with bullish money flow. We're not there on Momo, but I'll be watching. Take a look at the sector tracker now. Movement of the major sectors over the last 5 days. There's that defensive feel at the top of the list. Part of it is defensive, but to me, I think the bigger picture, and we'll take a look a little bit later on, is the decline in rates, right? 10-year yield has backed off from the 2% level. That has helped the utilities and real estate. See them in the top two spots over the past 5 days. Very much a similar feel to a lot of what went on last year in the market, where these defensive bond proxies were leading along with tech. Right, here's tech in the number 3 slot. Comms, a group that we have warmed up to recently, continues to do well. Staples, healthcare, discretionary are middle of the road, all higher over the last 5 days. Materials and industrials higher over the last 5 days, but towards the bottom of the list. Now that decline in yields has impacted the financials. Financials have backed off on a relative basis, despite some well-received earnings from the big banks last week. So continue to monitor rates to take your cues on financials and continue to avoid energy, right? Just a lagging group. Could not get much upside traction. Fundamentals remain bearish. Now oil is rolling over. Energy stocks continue to underperform. XLE has a bearish rating here at Chaikin Analytics at the ETF level. Just want to continue to avoid that group. Let's take a look at our industry in focus now. Retail services underperform over the past 6 months by about 2.8%. However, that power bar ratio, which measures future potential, is strong. 22 to 16 bulls to bears, but it's ranked 16 of 21 subsectors, having moved down one slot over the past week. Some of the indicative names in there, 3 of the 22 with very bullish ratings: Signet Jewelers, SIG, Groupon, GRPN, and Office Depot, ODP. Very bullish power gauge ratings at Chaikin Analytics. But for me, the group is really very much a mixed picture, right? We've had this nice rally since August that has now bumped its head on resistance at the $46, $47 level. Neutral rating for XRT, the ETF we're using to look at this group. Trend is strong above the rising trend line. Money flow bullish, but underperformance keeps us at bay. So we have a neutral fund that's now beginning to underperform the market. Overbought, oversold indicator, rounding out of an oversold position. So kind of getting into a bit of a no man's land there. As I'm thinking about leading areas of the market, I don't immediately come to retail, right? Neutral ETF rating. Tried to get some upside momentum on a relative basis, couldn't do it. Now underperforming once again. Have a solid resistance level here at the $46, $47 level. To me, I'd rather step away and watch this one. Not really exciting to me. Now, you can start to drill down on individual names, right? But as far as having a tailwind from strength across the group, I just don't see it there for retail at the time being. Obviously, that could change at any given moment. Let's take a look at what was trending yesterday. S&P 500 gainers and losers, our movers and shakers. Abumed's been a volatile one. Remember, they pre-announced at the JP Morgan Healthcare Conference last week. Stock was higher by 4.75% yesterday. Didn't see a ton of news flow. What I think sometimes happens is a lot of investors go to these big conferences. They go to a lot of meetings. They finally have a chance to kind of come back over the weekend, sit down, digest their notes. Maybe that's what happened here with Abumed after seeing some of their presentations that they made at the conference. Investors like what they heard. Perhaps that was the case. Nothing company specific there. CenturyLink CTL. This one is very much a yield play. So as yields have come in, CenturyLink has started to crop up on radar screens, up 4.7% yesterday. Lennar up 2.93%. Home builders are starting to stabilize and move higher once again. Costco caught an upgrade at OpCo. Costco upgraded at OpCo, up 2.82% yesterday. Micron, part of that semiconductor group that you know we love so much right now. Micron up 2.25% yesterday. Nothing company specific to drive trading there. Cabot Oil and Gas down 7.73%, part of that beat up energy group. Three of the other four names on this list, MGM, Wynn, and Las Vegas Sands, are all casino gaming names that have large exposure in Macau. So the threat of a virus spreading in China has the potential to limit travel around the country, right? The gaming names in Macau very much rely on the tourism industry of people coming from China to Macau to frequent the casinos. The casino stocks hit yesterday. MGM down 6.2%, Wynn down 6.1%, Las Vegas Sands down 5.4%. We'll round it out with Regeneron. Was the biggest loser in the XLV yesterday. Remains with a very bullish rating here at Chaikin Analytics, however, so it might be an opportunity to take a look at the stock if it's becoming oversold. Let's dive into the charts now. Wednesday is sentiment day, and sentiment more greedy than fearful, actually becoming more and more greedy than fearful. Here's the 13-day moving average of the CBOE equity put call ratio, and you can see it's just plunging to levels below the levels that we actually saw back in January 2018 when the market started to top out. Now, I'm not trying to, pull the fire alarm in a crowded theater here. I'm just pointing out the fact that sentiment is overly bullish at the time being, right? If I do my work, our overbought, oversold indicators at Chaikin Analytics are overbought for the SPY, overbought for the Q. So what does that mean? To me, that means you just become more selective with your long ideas, right? If there's something that's kind of like a middling opportunity, leave it alone, right? I think sentiment is a little too frothy here for the time being. Markets are near term overbought. Take a look at the VIX in the middle of the screen, right? After the brief blip up towards 14, it's back down with a 12 handle on it, all as the market continues to move towards and trade near record levels. So to me, I use sentiment as number one, not a timing tool. Number one, not a tool that says, I'm all in or all out, but I just use it to get a gauge of the landscape, right? Is it a headwind or is it a tailwind? When sentiment's a tailwind, i.e., when investors are too bearish, that to me tells me, I want to get more aggressive potentially on the long side of the portfolio, right? I have this tailwind behind me of money that could get put to work. These levels, sentiment's certainly not a tailwind, right? I think we're overly bullish. That's how I use that. Do I want to go to cash? No. But do I want to be more selective with long ideas? Yes. Do I want to continue to move up my stops on the names that are working? Yes. Continue to manage risk, become more selective with new ideas, with markets overbought and sentiment a little frothy here. Now, small cap growth as emerging leadership. I'm asking the question. We're looking at the Russell 2000 Growth ETF, ticker symbol IWO, right? Nice breakout, similar to what we saw in small caps in general back in the towards the end of last year. Above the rising 200-day moving average, momentum confirming, right? Look, after not being able to come overbought at all throughout the majority of 2019, we've now become overbought 1, 2, 3 times. So momentum shifting, right? Confirmation to the price trend that we're seeing here. Maybe a little overdone in the near term, yes. But what I'm also interested in is this break of the downtrend line relative to the S&P 500. IWO relative to SPY, clear downtrend for the majority of 2019. Now is broken topside and is holding above that downtrend line. So we're going to watch as for potential opportunities here in small cap growth. If small cap continues to work, if growth continues to work, I think you'll find some opportunities in this space. Finally, the 10-year yield is under pressure. We were off on Monday. We didn't do our macro view. Take a look at the 10-year yield, rallied up towards 2% and then began to fade below the declining 200-day moving average, now back below the 50-day moving average, so far holding the uptrend line. But take a look at momentum starting to fade here. So it's just kind of interesting as we were talking about the bond proxies, as we were talking about the financials. I think what happens next here at this trend line is going to be really important. So that's going to wrap us up for today. Just wanted to highlight once again, we are offering up a 14-day trial to Chaikin Analytics, where you can see those indicators that I use, Chaikin money flow, Chaikin relative strength, as well as the Chaikin Power Gauge rating for any stock that you're interested in. Head over to chaikinanalytics.com/test drive to sign up. I'll be back here tomorrow.